So this is the answer for question 1A. All countries are classified as bearer plants under FFRS 116 because they are used to produce FFB over many years and are not intended for sale. In contrast, FFB are biological assets under MFRS 141 because they undergo biological transformation until harvest and are harvested for sale. In this case, all countries are measured using the cost model, while the FFB are measured at fair value less cost to sale. This distinction ensures faithful representation because all countries are long-term productive assets, while FFB are agriculture produce whose value changes through biological transformation. Measuring each according to its economic nature provides a more accurate representation of company A's asset and, and financial position.
For part B, I don't think the self-evaluation method achieves faithful representation under the ISB conceptual framework. This is because the evaluation uses the full market price of harvested FFB for emerging FFB without considering important risks such as weather condition, disease, and uncertainty in future yields. As a result, the information may not be complete, natural, or free from error. In addition, emerging FFB are different from harvested FFB in terms of their economic value. Although both are biological assets under MFRS 141, emerging FFB are still going through the biological transformation process and not ready to be sold. Therefore, a more appropriate valuation should take into account the stage of maturity and the risks involved before estimating. For part C, as a junior accountant, I may face ethical issue if I follow the CFO instruction without questioning it. This could go against the principle of integrity, objectivity, and professional competence. I should first discuss my concern with the CFO and support my opinion using MFRS 141. If the matter is not resolved, I should report it through the proper internal channel and keep records of all discussion. Besides being responsible to my employer, I also have a duty to investors and other users of the financial statement to ensure that the information provided is accurate, reliable, and fair. For part C, as a junior accountant, I may face ethical.
So for this question, for the property one, the corporate and retail tower, a dual classification is required between MFRS 140 and MFRS 116 because the floors can be legally subdivided and sold or leased out separately. They must be treated independently. The 7 floors leased to independent retail businesses to earn rental income meet the criteria for MFRS 140 investment property. The third floor, used as corporate headquarters, are owner-occupied and fall strictly under MFRS 116 property, plant, and equipment. This must be depreciated, meaning the CFO cannot recognize fair value gains for disposition. For property 2, the horizontal land plot, the classification for the property is fall under MFRS 140 investment property. Under the standard, land acquired with an undetermined future use, where management remains undecided on whether to develop it for sale or hold it for long-term growth, defaults to an investment property held for capital appreciation. For this plot, the CFO can legally apply the fair value model. For the last one, the property 3, the Zenith condominiums, the CFO's proposal completely falls apart here. This asset must be classified under MFRS 102 inventories. Although it is a high-rise residential complex currently under construction, the company's explicit business model is to aggressively market and sell the individual units to home buyers in the ordinary course of business. Because these units represent trading stock, they must be carried at a lower cost and net realizable value (NRV), which strictly blocks the use of fair value model.
Next, we move on to our next question discussion. For property 1, the first 7 list floor is recognized as investment property, which is MFRS 140. The initial measurement for this is investment property shall be measured at cost including transaction costs. For the subsequent measurement, the company used fair value models, so changes in fair value are recognized in profit or loss. For the 3 owner-occupied floors, it recognized as PPE, which is plant, property, and equipment under MFRS 116. The initial measurement is shall be measured at cost, and the subsequent measurement is that the entity may apply cost model or evaluation model, and if the company use cost model, the carrying amount is cost less accumulated depreciation less impairment loss. For property 2, this is recognized under MFRS 140, which is investment property. For the initial measurement, is investment property shall be measured at cost. For the subsequent measurement, since the company used fair value models, so it will carry at market value with gain or loss recognized in profit or loss. Property 3, it recognized under MFRS 102, which is inventories. The initial measurement is inventory shall be measured at cost, including purchase cost and other costs incurred to maintain the inventories. And for the subsequent measurement, the inventory should be measured at lower and net realizable value, and fair value cannot be recognized before the units are sold. We'll move on to the next questions. To answer why the CFO or Chief Finance Officer proposal violated faithful representation is because the IASB conceptual framework stated that useful information must faithfully represent economic substance of a legal form.
For the product recall, the company should recognize a provision because the criteria under MFRS 137 are met. There is first a present constructive obligation from the contaminated products and announced recall, a probable outflow of resources with 70% expected returns, and a reliable estimate of 1 million ringgit. Therefore, the company should recognize a provision with the journal entries debit product recall expense of 1 million ringgit and credit provision for product recall 1 million ringgit. For the consumer lawsuit, it is classified as a contingent liability. Although there is a present obligation and the potential settlement that can be estimated between 2 to 3 million ringgit, the outflow is only possible because there is only a 30% chance of losing the case. Therefore, no provision is recognized, but instead, it should be disclosed in the notes to the accounts as contingent liability under MFRS 137. Under MFRS 137, the standard requires an assessment over the probability of the outflow or inflow of the economic resources. For a provision, it is recognized when there is a present obligation from a past event, the outflow of resources is probable, and the amount can be reliably estimated. For a contingent liability, the obligation may exist, but the outflow of resources is only possible rather than probable. Lastly, for a contingent asset, it represents a possible inflow of economic benefits. However, the asset and incomes are only recognized when inflow becomes virtually certain. Therefore, under MFRS 137, uncertainty affects not only whether an item is recognized, but also how it is presented in the financial statements.